Have you ever entered a trade, a perfect trade setup in the 5 minutes, and all of a sudden the market just reverses against you? Now, most of the time, it's not really about your entry. It's about the perspective that you probably had about the market. And today, what I'm going to be doing in this video is that I'm going to be showing you a tool that, smart traders use to analyze the market, and that is called multi-timeframe analysis. Now, if this is the first time you're coming to the channel, my name is Jonathan Obise, and I'm the founder of Paruto Capital, and it's always an honor to come your way, with tutorial videos like this. So today we're going to be looking at multi-timeframe analysis, and the title of the video says it's for beginners, but sincerely, if you're an intermediate trader and you're struggling with perspective, you enter trades, and when you enter trades, things just reverse, against you, then this video is for you, and it's going to be super beneficial to you. So without further ado, let's get right on to the video for today. Now, I have on my screen here my trading view, as you can see on the screen. Now, what is multi-timeframe analysis? Let's start with that. Okay. Now, multi-timeframe analysis simply means analyzing the same market across different time frames. That's literally what it means. So let's say, for example, on the chart here, I have gold. You can see gold that I have here on the screen. And what you see here is that I have the 4-hour, okay, on the left-hand side, and then I have the 5 minutes here on the right-hand side. So the 5 minutes could be the 15 minutes. So simply just analyzing multiple time frames, across, different times, as it were. Now, the essence of this is for you to sort of get a big picture. Now, think of it like Google Maps. So the higher time frame gives you the roadmap, okay? So, and the lower time frame shows you the street detail, sort of. Now, you need both to reach your destination, all right? So even though you know the roadmap, right, on Google Map, you need the lower time frame. You need to zoom in, to know the path to take, and to know all the signs and whatever you need, essentially, to get to your destination. That is essentially what the lower time frame, helps provide you with. Now, let's talk about, the top-down analysis explained in a deeper way. Now, if you look at how professional traders trade, you probably have heard the word thrown around, okay, top-down analysis. Now, it's simply a three-step process, okay? So the first step is this. You identify structure on the high time frame. Now, that simply means, let me just use a tool here. So the first thing, so 3 steps, okay? So we have three steps. Now, the first one is you identify higher time frame, okay, high time frame structure. So that's the first step. So your high time frame in our case here, for example, is going to be the 4-hour, right? So that's a high time frame. This is showing up on both timelines. So let me just keep this just within, the 5 minutes or 15 minutes now. So let me take out the hour, and same also for this. Take out the hour. So the first thing is you identify the high time frame. Okay. Now the second thing you need to do. Okay, so now that simply means, by the way, the high time frame could be the daily chart. It could be the 4-hour chart, depending on how you trade really. For me, it's usually the 4-hour chart. Okay, so you identify the high time frame. Now you start with the high time frame. Now, is price trending up or down? That's the first thing you're going to ask yourself. Okay, you mark the key levels. You identify your support, your resistance, your demand, your supply zones. You essentially just identify the market structure. Now, to put this in proper perspective, let me just drag all of this up. And yeah, so we can have some space. All right, so we have the first step, identify the high time frame. So what you want to do when you in terms of, you looking at the high time frame is to analyze different things, the bias of the market, the trend of the market. You want to find your highs, you want to find your lows. You want to know if the market is ranging or if the market is trending. So we have here our high, low, okay? Is that a high? That's a lower high, the low. So this is a bearish trending market, for example. So with this now, we do know that that's a high right there, right? And we have another one here. This is a lower high, and then we have another one, okay? And then we have another one. So from what you can see here, this is clear as day that the market is trending bearish, right? You can see it's simply just falling. So that means the market is trending bearish, okay? And if this were to be inverted the other way, the market will be trending bullish. So what you want to do when you identify your higher time frame structure, the first step is find the trend of the market. Now, if you're able to find the trend of the market, that really just brings you to a place where the mistakes you could have made, as a matter of fact, will be dropped to about, let's say, 80%, sincerely. Because if you trade in the direction of the major trend, you'll most likely get your trade entries correct. So that's the first thing you have to do. Now, you also have to mark your key levels. So the key level here, for example, for a bearish trend market will be our supply zone. So for this, we're going to draw this. Okay, and I'm just going to put that there. So these are our supply zones. We have this. Okay, our supply zones, we draw all of this. Now the supply zones, of course, because this is for beginners, so the supply zone, just in case if somebody watching this and you don't know what that means, is simply just the area where price reacts from. Okay, so those are just reaction points of interest where when price gets there, price has to react from the supply zone, and all of that. So that's our supply zone. So you identify your key market structure. So your supply zone, your support and resistance. Some persons call it support and resistance, but in our own case here, we consider zones are not really support lines, as it were, because price usually will react to a whole bunch of maybe a range or a zone, and not just maybe a particular line or a specific line or something of that nature. So when you do this, you've basically just fulfilled the first step, which is identify, your high time frame structure. So you've noted that, okay, now the market is trending, let's say bearish in this scenario, and now we're super good. Okay. Now the next step is you zoom into the medium time frame. Now your medium time frame, okay, so let me just copy this. You zoom into your medium time frame. Now your medium time frame could be anything from maybe the 1 hour. So if, for example, your higher time frame was the 4 hour, your medium time frame will be something with around maybe the 1 hour to 30 minutes thereabout, So we zoom into the medium time frame. So zoom into the medium time frame. Okay, so that'll be the next step, right? So what we want to do here now is this. We want to refine our zones. Okay, on the high time frame, you've identified like what we did here. Oh, sorry, okay, good. Wonder why that took time. So anyways, what we did here, the first thing we did was we identified the high time frame. Now the second thing we've done is to zoom into the medium time frame. And like I said, for me, my high time frame usually is the 4 hour. I usually just analyze the 4 hour, okay, because I'm an intraday trader. Some other persons, look at something like the daily, the weekly, okay, but it's all about how you trade. So the medium time frame is going to be something like the 1 hour or 30 minutes, okay, depending on how you trade. So it's going to be like the 1 hour, 30 minutes. And this is essentially what you need to now zoom into to now refine your zones. Now, why do you need to do that? Why you need to do that is because looking at the high time frame, the 4 hour, usually the zones are going to be very large. And you have to remember that within every 4 hour candle, you usually have about 4 1 hour candles. Okay, so the zone most likely will be very large and you have a lot of movement, on the lower time frame. So you have to now look at, the multi-time frame so that you can now refine your zones, okay? Refine your zones sort of beyond what you must have done, on the 4 hour. So if you do that, on the 1 hour, on the 30 minutes, you have a better, refined zone. Now we're going to be looking at this practically in the market. So don't worry about, all I'm drawing. I just want to establish, the basis for the video today that we're going through. So you zoom into that, you refine your zones, you spot things like liquidity, potential reaction zones. Also on the medium time frame, the same thing you do on the high time frame. You look for alignment with the high time frame. Now what you want to do is, if the market is trending bearish, on the medium time frame, you want to look for alignment with the higher time frame. So if we have a bearish market, I wouldn't be looking for a bullish, market on the lower time or the medium time frame. I'll also want to look for the same pattern, bearish on the high time frame. I also want to look for the same thing on the medium time frame, right? Because I want everything to be aligned, and that's very important to understand. Okay, so we look for the same thing on the medium time frame. Okay, we identify all our liquidity, reaction zones and all of those things. Now, step 3 is to drop to the lower time frame, okay, for execution. So, step 3, this is step 2, by the way, and now this is going to be step 3. All right, so step 3, we're going to zoom into, or we're going to drop down, okay, to the lower time frame. So drop down to the lower time frame, okay, structure. So for me, usually this is going to be the 15 minutes or the 5 minutes. Yeah, so I would say 15 or 5 minutes here. Okay, so 15 or 5 minutes. Okay, so you zoom into or you drop down to the lower time frame, all right, and then this way you're able to now execute your entries on the lower time frames. Now, on the lower time frame, now you need to understand that first, step 1, this is super simple. And that is why it's something that everybody should know, every trader should know, right? The first thing you do is that you start on high time frame. You don't just jump into the 5 minutes and say, oh, I've seen the 5 minutes trending bullish, it's trending bearish, and then you just jump into it and you want to take a trade. No, if you do that without context, the high time frame or the medium time frame, you'll have problems. So what you want to do first is establish the structure of the high time frame. You know the trend of the market, and as they say, the trend is your friend. So you don't want to find yourself always trading against the trend. Excuse me. It's really not something that's going to help you long term, right? So always identify the structure in the high time frame. When you get the structure in the high time frame, zoom into the medium time frame structure, and identify the same thing, zoom into the details, draw your zones, refine the zones, refine the supply, the demand zones, and, make sure it aligns with a higher time frame. Now, when you've done that, you now come into or drop down to the lower time frame. And now in the lower time frame, all you're looking for is execution. You're looking for entries to execute. Now, the lower time frame, like I said, this is where you take your entries. So you wait for confirmation, break of structure, retest, reversal patterns. We're going to do that because I'm going to be walking you through the chart practically. I'm going to show you how to do that. Today, it's, what's today's date? Today's the 15th of October. So I'm going to show you the price action from yesterday. And you're going to see how all of these things, play out. So when you zoom into the lower time frame, you look for your entries, you place your stop loss, you place your take profit, your entries, and you also wait for additional confluences or confirmation, maybe whatever it is, whatever strategy you use, break and retest, chalk, change of character, boss, break of structure, liquidity sweep, and all of those things. You have to wait for those things to execute on the lower time frame. Okay. Now, there are a few things I would want to emphasize. Okay. Always trade in direction of the higher time frame. And I think I've said that before, but this is something I just want to emphasize so that you really get this, right? So the lower time frame is your sniper scope, not your compass. And that's very important to understand. So the high time frame is your compass. Okay, so I'm supposed to go this direction, just like the map, but the lower time frame is your scope. You zoom into the detail and you want to make sure you get it right. Now, let's look at something here. So using the higher time frame, for buyers and then lower time frame for entry. Now, here's how to practically combine both. Okay. I'm going to now go to the chart. So let me go to the chart. So this is the 50 minutes chart, like I mentioned earlier, that we're looking at. So I'm going to do something. I'm going to take this. Let me replay this from here. Let me replay this from here. Okay. So let me take this. I think I can also have a split screen for both the 4-hour on one side and then the 50 minutes on the other side. I think I can do that. Yes. So I have the 4-hour here. This is a split screen. This is the 4-hour chart on the left-hand side, and then I have the 50 minutes here on the right-hand side. Right? Now, let's do this. So let's look at the 4-hour. Just the 4-hour alone. If I zoom out right here, you can see clearly as day that the 4-hour is bullish. Right? I want to believe you can see this very clear. If we just take this line and we just draw the line, you can see the line is ascending. So that simply just tells us it's a bullish market. Okay. Now, you see how when it comes to multi-timeframe analysis, it's really something very simple. But the problem I think most of the time for a lot of people is that they just jump into the market and then they just want to trade immediately without doing all of these things. And then a lot of times they get caught on the wrong side of the market. So now that we know that the gold on the 4-hour is trending bullish, it would simply just be foolishness, right? If we try to trade against the market trend. So we would definitely want to trade in the direction of the market. So now I'm just going to do this. So I've already, of course, sort of taken the chart to the 14th of October. So this is the 14th of October. Now this is the candle that started from like 3 a.m. based on my time, UTC+1. So I've taken the chart there to replay everything from there. Now, how do we now determine how we trade? Okay, this particular trend in the market. Now, the first thing I'm going to do is I'm going to draw this. This is a break of structure in the 4-hour. And of course, this becomes a demand zone. You can see it's a very large one, but I'm going to draw it all the same. Okay. And we have here our demand zone for the 4-hour. Okay. Now, what do you expect? After price takes out a high, what you expect is a pullback. Okay. And I drew the structure for us earlier. So you have something like this, high, low. When price takes out the previous high, what do you expect? Do you expect it to continue to go up? No, usually you'd have a pullback. So a little pullback, sometimes the pullback can be short like this and then it continues. Sometimes it can be medium and then it continues. Sometimes it can be deep and then it continues like that. So, but the central idea is after a break of structure, we always anticipate a market pullback. Okay. So now after gold took out this high, whilst you can still continue to trade in direction of the market, you have to bear in mind that the market is going to reverse at any point in time. Okay, so since we've identified the fact that on the 4-hour the market is trending bullish, we're super good. Now we have our demand zone drawn, so we know that if price was to sell, it will come in here and then react, from there. So we're super good. Now there are also other concepts that I may not be able to introduce in this video for you, but something like breaker blocks. Price also can react from a breaker block and not just from the demand zone. So that's also something to have in mind. So now let's have the two charts side by side. Now this is the 50 minutes chart I have here. You can see it's also bullish. It's been bullish, and you can trace that from here when price started pushing to the upside, and you can see the same push, on the 50 minutes to the upside. However, on the 50 minutes we have a lot more action in terms of the candles. Now for me, in terms of my entry for gold, I usually love the 5 minutes. So you'll permit me, let me drop to the 5 minutes, right? So I'm going to drop to the 5 minutes here. Okay, so now we have the 5 minutes here. So gold is currently here, and this, by the way, is the same with this. So gold is currently here, and let's look at the time. The time is 6:10 a.m. All right, UTC plus 1 time. Now this is London session. This is pre-London session. Now what that just tells us is that from Asia, all through Asia session, we've had a bullish trending market. Now we're coming into London session. What do you think is going to happen? We also would expect a pullback. Now this is something you have to know. This is not, I'm not looking at that specifically in this video, but when you come into a new session, you should always anticipate a pullback. Okay, something you should always anticipate, because the market just has to sort of cool off. Yeah, it happens. So now we're coming into London session. So we're not just going to say, oh, I see here a breaker structure. And because I see a breaker structure here on, the 5 minutes, I'm just going to jump into the trade and just take the trade. I see this has a breaker structure, and I just look for a zone and say, okay, let me just draw this out. And when price comes and taps into this demand zone, and then I'm going to put my demand zone there, and I'll put my entry here, and I'll say, okay, when price comes into this demand zone, I'm just going to take it up. Okay, just like that. No. Now, this is where experience also comes into, how you also trade the market. So if I see something like this, and I'm seeing that, okay, all through Asia session, price has been bullish, I'm not just going to jump into the market. I would have to wait, okay, for a while to see what the market is going to do as the session opens, because I'm really expecting a pullback. And that pullback sometimes can be very aggressive, especially when a lot of liquidity has been built, over the previous session. So you can see from Asia session, we've had a lot of liquidity lying around here. So sometimes that pullback can really be deep, because price may just decide to clear the entire pullback. Okay. And in this case, that was exactly what happened. So let's see what happens. So I'm going to take this out. So I'm going to play the candle, and let's see what happens. Okay, so there we go. So you can see this was around 6:40. This is pre-London session. You can see how price just dropped, literally just dropped. Okay, now if you were trading the lower time frame without context of the higher time frame, you would have had issues, with this, because number one, you wouldn't probably anticipated the fact that the market is going to sell if you're not also aware that, or if you're not aware of the idea that after a session, the market will usually pull back when going to the next session, especially when you had a trending market. In this case, a very bullish market, the market might pull back very aggressively. Okay. And now we have this. Now, when you see this, a novice trader is going to say, oh, I see the market is reversing. Okay, let me look for short positions now, and let me start selling the market. But someone who knows high time frame analysis is going to say, no, hold on a minute. On the 4-hour, the market is still trending bullish. Nothing has changed on the 4-hour in terms of the market structure. I know that the market structure on the 4-hour is still bullish. So this is just a pullback, a temporary pullback to facilitate, take more orders that will then facilitate, the next leg in terms of price action. So when we see this, we just allow the market to settle, right? So let's allow the market to settle. Now, when you begin to see this just tells you that the momentum is sort of slowing down. Okay. Now, I'm replaying this, of course, this is not a live market. So if this is playing the live market, you have to wait. It's something you have to observe, right? So, but this just tells you the market is slowing down. But then that doesn't necessarily mean that you just have to jump into the market. You still have to wait. Okay. Now, like I said, multi-time frame, trading 4-hour, trading 15 minutes, and just combining all of these things. This is just how smart traders trade, and you just have to learn this, okay? If you really, really want to take this, I'm serious. So I'm still going to play this. So this is like 7 a.m. All right. So you can see that even though the market sort of slowed down here, it's still, pushed lower past the last low that was created. So we just allow the market to do its thing. And now the market is still selling. All right. Now look at this. We've had a massive sell. Price came here, rejected, sold again here, and now rejected. Okay. So while this is happening, there are a few things also you need to do depending on the strategy you trade. But I'm just going to show you a few things here. You need to look at the left-hand side, okay, and see if there are any POIs, demand zones, that price could react from, okay? And also, if you have any structure on the left-hand side, maybe for sweep of liquidity, price sweeps liquidity, and all of that, you need to look at that. So here I'm going to draw this structure. So we have here this breaker structure on the 4-hour, on the 5 minutes. Now, this essentially means that this low, looking at this price action here, has been swept. Okay, so that's a sweep of liquidity. Let me just take out that so it's very clear. So you can see that price swept that low, right? Just a little swept it. Okay, now if I look at the left hand side, I can also see here that we have a demand zone. We have this demand zone here. I'm just gonna put it below this. So we have this interesting demand zone. And now, mind you, this is basically coming into London session, and price has been bullish all through Asia session. And now coming into London session, price swiftly dropped. So what I'm expecting is, I'm not expecting price to continue to drop forever. I'll be expecting a reversal in the direction of the higher time frame, because I know that the high time frame is bullish. Okay, so since I know that the high time frame is bullish, I'm not just going to be expecting the price is going to continue to drop in perpetuity. I would have to sort of, anticipate that that price is going to continue, to move to the upside at any point in time. Okay, so that said, now we have this created, price has approached this demand zone and then has reacted from it. I could do two things. One is I can now say, okay, since I've seen this, I can place my entry here. This is nice demand zone. I know that this is pre-market price action. Price has dropped so fast, but I know it's not going to drop in perpetuity. Now, price has also sort of created what we call an engineered liquidity. Okay, just ahead of this zone, clear this low, and then clear this low, swept the liquidity there, but also the reaction is also in front of this demand zone. So based on this, I can actually enter the market and say, okay, I'm expecting the market to pull back, but then I'm going to put my stop below this zone here and anticipate that the market is going to push back up. So I'll just go for something like 1 to 4. Okay, now these sometimes might be sort of aggressive, okay, because the market hasn't really changed, from the sell to maybe give me some sort of bullish order flow. So I'm really being aggressive here with this type of entry. Now we can also take, confirmation entries. That means we have to wait for the market to change, because this is a bearish, drop. We need to wait for the market to change from that bearish drop, to a bullish order flow. Okay, if you get what I mean, before we now decide to enter the market. But this is an aggressive entry, and I'm willing to take this because I understand the nature, of gold, through experience and all. But I'm also going to show you the confirmation entry and how to trade that confirmation when the market changes. So now we're going to play this. This is around 7:35 a.m. and there we go. So depending on different factors, depending on the spread, your broker and all of those things, this trade might have been tagged in, or might not have been tagged in, but you get the idea. All right, so now looking at this, now let's go back. Let's look at both the 4-hour and the 5 minutes. We know that the high time frame is bullish. So now that we know that price has dropped so fast and has reversed, what do? We look for confirmation bullish entries. So looking at the 5 minutes now, what I'm going to do is I'm going to draw this. Okay, that's a break of structure, but also I can see here that I have an inducement here. So based on this, I can now draw my demand zone below that. Okay, and with this, I can take this, put this here. Okay, and I'll be expecting price to kind of, hopefully return and take out, this inducement, tap into this demand zone and then push higher. Now, but there's also something I can decide to be very conservative, because I know that ultimately I'm expecting gold to still go back up here. So I can decide to say, okay, let me put my, take profit there. And if I really don't want to be conservative, I can say, okay, put my stop loss below this area, still 1 to 4, and that's okay. All right. If I don't because you can't tell how price is going to react. Sometimes price can just sweep everything, before it goes back up. So I want to be really, really conservative. I could do this. Okay. Now, and I can only do this for me because I usually will just go for 1 to 4 and that's it. Okay. Until I hit a certain, milestone, I can decide to now begin to take, bigger RR. So I'm going to play this. This is 9:15. Price is going. Let's see. Now we're coming into, not yet. Okay. So this is still London. So this is now pre-New York session. Now we're coming into New York session. And if you remember what I said earlier, when you're coming into a new session, anticipate a pullback. Okay. Sometimes price, of course, can just take off and just go. But a lot of the time, price will usually pull back. And that is why, sometimes you have to be patient. You have to wait. So we still have our entry here marked. So let's see if we get that pullback that we need for New York session. Okay, so there we go. So price is approaching our entry. And there we go. So now this is around 2 p.m. UTC plus 1. This is New York session open. And we are now in the trade. Okay, so now this is a confirmation entry, right? This was a very aggressive entry, but this is a confirmation entry. And all of these entries, by the way, just to let you know that all of these are based on the fact that we know that the high time frame is bullish. So we're simply just taking trades in the direction of the market. We could have taken shorts, but shorts would be counter trend. Okay, while sometimes it may work, but you have to understand that those are counter trend entries and sometimes it may end badly. Okay, but we know this is bullish, so we expect market continue to push to the upside. So let's see if we're going to find additional entries with this. Okay, good. Now we have here a break. Okay, we have here can just look at this as my inducement, and then I can have another entry here. Let's see if price is going to tag me in, if at all, and now just go for 1 to 4. Okay, So let's see what happens. Nothing for us. Okay, so price keeps pushing. It's just going. Nothing there. All right, price is just pushing. Can see nothing there. We can draw another one to see if we can get a continuation setup. Place this here. Stop. 1 to 4 still. Okay, let's see if we get something. Now, by the way, what you see here is all the entries based on the fact that we're looking at the we've already established that the 4R is trending bullish. So we're not looking for any bearish trend. Now, the problem most of the time for traders or, new traders or beginner traders who just come into the market, and when they see this type of move, they say, oh, the market is bearish. Now I'm going to enter and trade the market and, take out this line, all of that, because they just saw this price action. And if you look at this, in all honesty, you have multi, breaker structure, right? You see that? The market is trending bearish on the 5 minutes. But if you have an idea of what's happening on the high time frame, which is the 4R, you know that, okay, this is just maybe some temporary pullback. The market is actually trending bullish, right? So with that now, we have this. Let's see if we get an entry. Oops, no entry. All right, so no problem. We take this on. Now with this, we can have this. Now why? Because we have here engineered liquidity. Okay, so we have that. You take this. Like that. As always, I can choose to be very conservative and put my low below this, okay, and then still go for 1 to 4, or go for 1 to 3, depending on whatever I want to go for. So we're just to protect my stop, right? So let's go. An entry. All right, price is still not there. Okay, good. So we're in. This was around 8:35. Yeah, that's quite late. Anyway, so that's it. So price is now pushing out. So let me just play this to the end and let's see what happens here. Okay. All right. So with this, basically price has hit all of our targets and we're super good. Now there were other entries I could have shown you, but you get the gist. Okay. Now this is just to show you that multi-timeframe analysis can really just help you to be on the right side of the market. Now, the formula is high time frame direction, and then that leads to lower time frame. So, of course, your entries, your stop loss, where to place your profit. I did not explain all of that because I want to assume you most likely knew that. But if not, just leave a comment in the comment section, and I'll be able to, do a video on that. I want to believe you've really picked something, from this, right? Now, the biggest advantage of multi-time frame analysis is really context. You just get context, okay? Now you understand where price is in the overall story. Now, before you take, any trade, you have to ask yourself these questions. What's the high time frame structure? The first thing, what's the high time frame structure? If you know the high time frame structure, then you're ready to go into maybe the medium time frame or the lower time frame to establish structure in the same, in sync with the high time frame structure before you decide to take a trade. Now, what are we within that structure, or where are we rather within the structure? That's also another question you have to ask yourself. So in this instance, this price action that we just went through, we knew where we were when price was here, and we knew as we're coming into London session that we're expecting a pullback, and that pullback was very aggressive. But once that happened, we knew then that the market was going to continue to trend bullish. Okay, so you have to know where you are in terms of, the structure. And then the third question you have to ask yourself is, does my lower time frame entry align with the bigger picture? So you wouldn't enter and begin to short, okay? You have to establish that, okay, your time frame aligns with the bigger picture. Okay, so when you build context, you reduce noise, you increase accuracy, and you trade like a strategist, not a guesser. You're not guessing, right? You're trading in the direction of the high time frame, so you trade like a strategist, all right? So now, let me just leave you also some bonus tips. Now, aligning, with market circles. Now, each time frame tells a part of the market story, okay? Now, the weekly daily shows the macro cycle, okay, what's happening in terms of the macro cycle. The 4R, the 1 hour shows momentum and setup zones. The 15 minutes, 5 minutes shows entry timing and execution. Now, aligning all three of this, it's like trading with the wind at your back. Simply, you're not struggling, okay? You're not trying to push yourself too hard. You're not looking for setups, too hard, because you're simply just trading with the trend, so the wind, is supporting you and all of that. Now, I'm going to leave you with this. Now that you understand how smart traders use multi-timeframe analysis, okay? Now, I want you to go back to your own chart, and analyze, what we've just done on your own. I want you to be able to identify some of the things that I've identified, in the course of this video, because it's very important that you also get to, practice what I've just shown you. Okay, so go to your own chart, replay the chart, the time frame, identify the high time frame structure, go to the medium time frame, establish or refine your zones, go to the lower time frame for your entries, refine the zones, refine the entries, look for confluences, bosses, break your structure, liquidity sweep and all of those things, and try to see if you can catch, those entries. All right. Now, if you do that, I'm very certain, that you're actually going to be at a very good place. Before I let you go, I want you to practice this, with every single trade that you take from now going forward. And I would love to know, what is your own go-to time frame, combination in the comment section. Like I told you, for me, I trade the 4 hour, the 15 minutes and 5 minutes most of the time. I hardly actually look at the 1 hour, and also I hardly look at the daily, but I just trade, the 4 hour and all of that. But you may be a swing trader and you want to trade the daily, the 4 hour and the 1 hour, and that's perfectly okay. So, but just let me know in the comment section. And also, if you found this video helpful, really, I want you to hit the like button, subscribe, turn on your notification bell also for, the video I'll be releasing next, because a lot of videos are going to be coming like this. And also, if there's a topic you would love me to cover, you can also leave a comment, so that you never know, that could be a topic I'm going to bring to you next time. So until next time, trade smart, stay consistent, and keep growing with Paruto Capital. But also, just before I leave you, by the way, Paruto Capital, we have the Discord channel. So you can just check the description. You see a link to join the Discord channel. We also have different plans. If you want to join the mastermind, where I trade with traders every single day, we discuss, we chat, so many things happening there. If you also want to take the course, you can also go to our website, parutocapital.com, and you have, you have a number of courses you can decide to, to enroll on the platform. So whether it's, basics or trading mastery, or you want to look at a psychology and performance course, or you want a one-on-one elite traders program, you can also look at all of that. So whatever choice you make, I'll be seeing you next time. So it's been a pleasure coming your way today. Enjoy and cheese.